Gold has quietly crossed a line that most people were not watching. Prices are breaking records repeatedly, yet very few are asking what this really means. By the end of this video, you will understand why gold is behaving this way, who is losing control over its pricing, and what this shift could mean for anyone holding cash, savings, or long-term investments. This is not hype, it is structure. And the signs are becoming harder to ignore. What if gold is not simply rising in price, but repositioning itself inside the global financial system? What if this moment looks far more like the 1970s than most people realize? This analysis is based on research by Professor William Liebenberg, and what it reveals challenges many long-held assumptions about money, power, and control. Gold is one of the oldest stores of value in human history, but its modern price movements tell a much deeper story. Prof traces the price of gold per ounce at decade intervals from 1970 through to early 2026, not to admire numbers, but to understand what kind of financial environment produces these shifts. Gold does not move randomly. It reacts to stress inside the system itself. In 1970, gold traded at roughly $36 per ounce. By 1980, it surged to around $615, an increase of more than 1,600% in just 10 years. This was not a normal bull market. It was the result of the collapse of Bretton Woods, rising inflation, oil shocks, and a world moving away from fixed exchange rules. When trust in monetary systems breaks, gold responds. From 1980 to 1990, gold declined by nearly 40% as the system stabilized temporarily and fiat currency dominance expanded. From 1990 to 2000, it fell further as equity markets and credit growth absorbed global capital. This was the era when money was fully detached from gold, and confidence in paper systems appeared unshakable. But that confidence would not last forever. Between 2000 and 2010, gold surged more than 300%. The trigger was not speculation, but crisis. The 2008 financial collapse exposed structural weaknesses in the global system, and once again, capital moved towards something tangible. Investors did not run to gold out of fear alone. They ran because trust had been damaged. From 2010 to 2020, gold continued rising at a slower pace, punctuated by volatility and renewed demand during the COVID era. Then from 2020 to early 2026, gold accelerated sharply again, rising roughly 170% to around $4,800 per ounce. This raises an important question. Why does gold surge most aggressively during moments of systemic transition? When comparing all decades, one stands above the rest. The period from 1970 to 1980 remains the most dramatic increase in gold's history. This was not cyclical movement, but regime change. Fixed systems collapsed, inflation surged, and confidence fractured. Prof argues that today's environment shows striking similarities, only now the stresses are global, digital, and far more complex. For decades, gold pricing has been dominated by Western financial centers such as Washington, London, and New York. Institutions like the LBMA and COMEX helped shape gold as a traded asset rather than a monetary anchor. While prices are technically set by markets, pricing influence has historically been concentrated. That dominance, however, is beginning to fragment. Emerging blocks such as BRICS are building alternative financial infrastructure. Gold trading hubs in Shanghai and Singapore are expanding. Countries are exploring bilateral settlements, increasing physical reserves, and reducing reliance on traditional Western mechanisms. This is not speculation. It is visible in reserve data, settlement experiments, and policy direction. If pricing power is fragmenting, who benefits? And who is left holding the risk when confidence breaks? This shift naturally raises a controversial question. Could gold ever reach $40,000 per ounce? At first glance, it sounds extreme. Yet under conditions of severe monetary debasement, collapsing confidence in fiat currencies, large-scale reserve realignments, or a partial return to commodity-linked systems, such levels move from fantasy into scenario analysis. The current global debt structure makes these discussions unavoidable. There are already signals pointing toward a gold-anchored framework returning in hybrid form. BRICS's unit pilot suggests a commodity-linked unit of account beyond Western currency dominance. XRP's integration with physical gold custody through digital settlement rails highlights how tokenized gold could function within future liquidity systems. These developments are not random. They are preparatory infrastructure. For investors, gold and silver have historically served as protection during uncertainty. Gold acts as the anchor, preserving value through volatility, while silver often behaves as a leveraged companion due to its industrial demand. Allocation is not about speculation, but about resilience in a world where monetary certainty continues to erode. From $36 per ounce in 1970 to over $4,800 today, gold's journey reflects far more than price appreciation. It mirrors the evolution of monetary systems, shifts in geopolitical power, and the repeated consequences of debt-based finance. The signs suggest that pricing control is fragmenting, and that old assumptions are being tested again. We have now reached a point where gold and silver are breaking all-time highs on an almost daily basis. This is not noise, it is signal. The wise understand where this road leads, because history has already shown us what happens when systems strain beyond their limits. We inform, you choose. In this library, we do not give false hope or sensational news. The information shared is grounded in observable reality and historical structure.